Dusad. Vaibhav Dusad is a fund manager, MF Equity, ICICI Prudential Asset Management Company Limited. Vaibhav joined ICICI Prudential AMC in December 2017. In his current role, he manages ICICI Prudential Equity Minimum Variance Fund, ICICI Prudential Focus Equity, and ICICI Prudential Technology Fund, and co-manages ICICI Prudential Blue Chip Fund and ICICI Prudential Innovation Fund. Boasting nearly 16 years of experience in the Indian equity market, Vaibhav have covered a broad spectrum of sectors. Before joining iPro AMC, he worked as a research analyst at Morgan Stanley India, institutional equities covering healthcare and pharma. Additionally, he has held position at HSBC Global Markets and CRISIL India in the capacity of equity analyst covering Asia telecommunications, media technology, and internet sectors. He's a postgraduate from the Indian School of Business, Hyderabad. He did his bachelor's and master's of technology dual degree and has done metallurgical and material engineering from the Indian Institute of Technology, Madras, IITM. He is also certified FRM chartered holder from the USA. So we are really privileged to have you here on this platform, Vaibhav, and the platform is all yours. Thank you so much for coming here. Over to you.
Uh, yes, hi. So thanks for the introduction. I hope everybody can hear me fine. Am I
Yes,
audible,
you're
right?
clearly audible.
So
Yeah.
yes, yes. So basically, with iPro, I've been for around now 7-8 years, and this is a new NFO which actually we are coming up. It's an interesting product. Apart from this product, I also manage Focus Equity Fund and Innovation Fund in ICICI Prudential. So these two are different fund, and this is the third fund, which is again a unique, unique fund, I would say. So basically, I think this product is fairly simple, and the broad idea of this product we came actually in 2020, but we find that today in the current market condition, it is more appropriate, for us to bring this product in the market. So basically, just maybe 1 minute. If you see, I think market. We already knew that market valuations were expensive, and they are still a bit expensive. Because of a very strong rally which we have seen in last 3 or 4 years. And apart from that, I think smaller and mid cap stocks are even more expensive than the broad market. Now, I think the challenge is that because of the expensive valuation and on domestic front, there has been a slowdown in the growth, because I think it's just the first year post election, and during the election itself, there was some slowdown, right? And then post election also, we continue to see that slowdown on the domestic front. And outside of India, I think the situation is still. I mean, of course, we have gone through elections in US, and outcome is also clear. But with that outcome, there are more uncertainties as well. That what would be the policies, geopolitical implications after a new president joined in US. So in a way, what I am trying to say is that volatility has increased a lot, and uncertainties have also increased a lot, both in domestic and global market. So I think in this context, the way to just a second. So in that context, if you see, I think where how do you actually invest in this context, right? So uh, so basically, I think basically what I'm saying is that the better way to invest in this context would be to stay invested in large caps. That is the first thing, and the second thing is that the second thing is that to shift the allocation from a small and mid cap to large caps, and then within large cap, I think you prefer something which is actually less correlated with many of these macro events, which is less volatile, where your earnings are stable. So that is the broad context. So now with that context, I think we have designed this product, a minimum variance product, and Bhavesh, if you can go to that product slide, minimum variance product slide. And I think just first two slides. I mean, this slide is also good enough. So if I hope everybody understands variance. What is variance? So that's important to understand what is variance. Why I'm talking about the variance. So variance is a statistical term, and to put it very simply, I'll give you one example. Like if you roll a dice, you will have six different outcomes. One, two, three, four, five, six. So there are six different outcomes. If you roll a dice, the mean value of these for over a longer period of time, let's say if you roll a dice for 1,000 times, average expected value is 3.5 for that. Okay, over a very long period of time, but there would be variations. From 1 to 6, you will get all sort of numbers. And instead of rolling dice, if you toss a coin, then only two outcomes are possible: head or tails, right? So I think uh, it just the predictability in case of tossing the coin is better than rolling a dice. For if you do it, while the expected value can be different for both. So I think that's what we are saying, that we want to find some stocks where I think the variation in the returns, variation in the earnings at this point in time is low, right? So we have a better we have a stocks which have a better predictability of earnings. So that is a broader context, right? About variance. Okay, and I think if you go down to Bhavesh, if you go down to minimum variance section, where we are actually describing the product, that could be useful.
Yeah, sure, Vaibhav.
No, further down, please.
Yeah.
Go down more. Yeah, one more.
पण आज होईल का? कारण 2 दिवस बंद होतो नाही पण मग इश्यू काय ते तर मला कळत नाही.
Our view.
Yeah, more. Yeah, more. Go down. There is a minimum variance. Yeah. So now, just stop here, please. So I think if you look specifically now, I'm coming on this product. Specifically, if you see, this product is Nifty 50 based. It's based on Nifty 50 benchmark. There are hardly any actively managed products on Nifty 50. So this is actually very unique, because most of the investment in Nifty 50 has gone to passive. So this is an actively managed Nifty 50 fund. Here we would actually, this is what this is. This is a mega cap focus, and I think in different pockets of markets, I think Nifty 50 is the only basket where you have maximum valuation comfort, because I think the returns have been low also in Nifty 50 in last 3 and 5 years. So that is one part, and the second part is that the main objective of this product is to uh, uh, you know reduce the volatility of the portfolio. In a way, the main objective of this portfolio is to reduce risk and deliver return. So we are targeting a better risk adjusted return. So that is a Sharpe ratio which we commonly know, but we are targeting better risk adjusted returns from this product. And if you look, I think this product is a good diversification for any of your clients, because they will not have this low ball kind of exposure in their current portfolio. So it is something which is more defensive. The mindset to run this fund would also be defensive. So I think that this is broadly the product, and the way we would run this product. I think there is a pyramid slide, Bhavesh. Maybe 2 slides down, you will find that. Yes, this slide. So if you see this slide, no, the way I described in the beginning, it is partial quant and partial active. So what happens is that within Nifty 50 stocks, quant model would throw a list of, let's say, 30-35 stocks, or 60% of the stock it will absorb, and 40% it will filter out. These stocks filtration is based on quant model, and this is based on the volatility of the individual stocks, right? So based on the volatility, we will shortlist these stocks, and after shortlisting these stocks, uh, we will do an active management with these shortlisted stocks only. In the active management, we will allocate what could be the right weight. Can it be 1% or can it be 10%? Can it be 3, 5%, whatever? And that weightages allocation would be actually dependent on the outlook for each of those individual companies. The companies, of course, with a better earnings outlook from near to medium term perspective would have a better weightage, higher weightage, and companies which are having relatively poor earnings outlook can have a lower weightage. So that's how we will allocate the weights in these stocks. And the final idea for us would be that portfolio variance should be lower than Nifty 50 variance, right? So the portfolio risk of this portfolio should be lower than the risk of Nifty 50. So I think that is a broader strategy to run this fund, right? And of course, in terms of the performance, I mean, we have certain benchmarks. Like if you look at the performance, Bhavesh, can you go to last few slides where we have the performance of 100 low vol ETF? Next slide. Yes. So you go back one slide, please. Yes. So if you look at this slide, no, this slide is saying, representing what is the performance of Nifty 100 low vol ETF 30 against Nifty 100. So what is happening is that this ETF is outperforming the benchmark by 60% of the time. For 60% of the occasion, it's outperforming the benchmark, and rest 40% it is not outperforming the benchmark. I think that is completely a model driven outcome, right? In this slide, whatever you are seeing, it is completely the model driven outcome. Now, Bhavesh, if we go 2 slides down after this, yes, if you see this slide, what this slide is saying is that how the return of this strategy has been in a time frame when the market has been volatile or when the market is correcting, and whenever there is a sharp correction. So I think whenever there is a sharp correction when the market is volatile, you see, I think this strategy has able to outperform Nifty 50, Nifty 100, sorry. So it's benchmark. So that is a time when this product is most suited. And I think what I can say is that looking at the state elections calendar for India, looking at the geopolitical events, looking at the war situation, I think we can easily say that next 1 to 2 years or maybe next 2, 3 years would be tough. They would remain volatile, right? So I think it will have ups and downs, but largely the market would be in this consolidation mode, perhaps with some bias towards downward declining bias, right? So so I think this strategy is very useful in this kind of time frame, and we are currently going through that kind of a situation. But not only this, if you go, I think maybe one slide up, Pavish. So if you see, this is the performance of this strategy when we are in normal time, when the market is not correcting, when the market is upward looking. Here also, I think the performance is not as good as the previous slide when we were in the down market, but I think it has been decent. It's not so much underperformance. There are few years where you see very sharp recovery in the market from an oversold region, oversold zone, something like in 2009, something like in June of 2020 in recent times. If there is a very sharp recovery in the market from highly oversold zone, then I think for first 6 to 12 months this strategy would not perform well, because I think this strategy fundamentally has low beta, right? So I think uh, in very few situations like that, I'm not sure, like in last 30 years there are three situations like this: 2008 kind of crisis, or 2020 kind of crisis, 2001. So I think apart from that, this is okay. Performance has been okay for this strategy. And I think last slide or last description from this product point of view, if you look, this product can have multiple sectors. It's not like it will have only defensive sectors. So of course, a large part of allocation would be, let's say, 40-50% allocation would be towards technology, pharma, and let's say consumption. But outside of that, I think 30-40% allocation can also be in cyclicals or in some different sectors such as banking, cement, um, industrials, like that. But what happens is that when market becomes very volatile and expensive, allocation automatically moves towards more defensive sectors. When market becomes very cheap, allocation moves towards more cyclical sectors because that's where I think the fall is more. So, the model automatically navigate between these two themes, and therefore, I think even in the up market, it able to give some decent performance, outperformance versus the benchmark. So I think that is what I think it is getting shown in this slide. Also, you see the sector weights. It has changed over a period of time, and it's not only one sector or two sector where it is focused on. It has multiple sectors. But yeah, from when you compare it with any tradition, when you compare it with any traditional fund, when you compare it again any traditional fund, this the differentiation for this product would be that it would have slightly or it would have significantly higher um, allocation towards defensive sectors versus any traditional fund. So I don't think you will find a fund where you will have 40-50% allocation towards technology, pharma, and consumption. So I think that's all I think from my side on this product. Yeah. So we can open up for Q&A.
Yeah, thank you, Vaibhav. Thank you for the insightful presentation. And yes, we do have received few of the questions, so which I will put it on screen for everybody's convenience. Just give me a moment. And I'll just read out for everybody's benefit. So I hope my screen is visible. Yeah. So my first question to you is how does the minimum variance concept work in the context of equity investment?
Just a second. Huh?
Yeah, sure.
Yeah, hello. So,
Yeah,
can you hear me?
Vaibhav, you're audible. Yeah, perfectly audible.
I think my Bluetooth is not working, but anyway, so I think how does the minimum variance concept work in the context of equity
Equity
investment?
investments.
No, I think it's a good strategy because what does this strategy do essentially is that it is trying to buy all the time stocks which have gone through consolidation and stock which have gone through underperformance, and then it's trying to book profit also in the stocks which are going through outperformance. So it continuously doing that process. It is continuously following that process without any human intervention. So I think as a strategy, this is globally well recognized as well. If you go and read on internet the low wall strategies, it's well accepted globally. In India, it is new because we have been always high growth market, but globally it's well accepted. And basically, in the process of booking profit and investing again in something which is underperformed, you generate returns in that.
Agree. Yeah. Thanks, Vaibhav. So I think you had already covered, but thank you for briefing once again. Yes, my another question to you is, are there any sectors or regions that are over or underweighted due to the minimum variance strategy?
So I think typically cyclicals would have slightly lower weight or underweight, and defensive would have slightly higher weight or overweight. that I think that bias would be there. So that we have to live with that bias. The advantage of that is that it prevents the performance. It prevents the underperformance. It prevents the underperformance when the market falls. Uh, and that that is an advantage. It of course sometimes performance is lagged in a strong bull cycle. But even with each of these bull cycle, you see last bull cycle which started in 2020, technology did superbly well. 2011 to 2018, consumption defensive sector outperformed all these sectors. So even within defensive sectors, some or the other sector take a leadership. 2008 to 2014, pharma took the leadership. So it's not like all defensive sectors are on backseat. Some or the other sector comes and takes a lead, because I think these are also say, fairly large sectors by market cap. So if market has to go up, it cannot go up without any of these defensive sectors taking lead. And cyclical sector, the problem is that it's for one cycle, and then in this next cycle it will correct so much that the representation of those stocks in the index also reduces significantly, like what you have seen in capital goods from 2009 to 2020, the weightage reduction.
Agree. Yes, thank you so much, Vaibhav, for the brief answer. Moving to next, my another question to you is, how does this fund differ from the traditional equity fund? I think you have already covered in your presentation, but just please throw some light.
Yeah, I mean, this would have more bias. You will not find, first of all, a single fund which can have 40-50% allocation in technology, pharma, and let's say consumption. Most of the funds would have little bit cap weights, because you see nobody is willing to take so much overweight in pharma, because benchmark itself has only 4% weight in pharma, right? So I think that would be the difference. The other difference would be the risk management part is little different. We will think about risk first here and then returns. And in other cases, we will think only returns and then risk is a secondary objective.
Okay. Yeah. So moving to next, thank you for answering the question. How is the stock selection determined in the ICICI Prudential Equity Minimum Variance Fund? What role does sector diversification play in minimizing the risk for this fund?
How is the stock selection determined in? So I think stock selection is based on normal active parameters. Let's say, it really depends on the earnings outlook, uh, the capital allocation policies, uh, how much it has underperformed, where is the inflection point. The stock selection process is normal, like what we do in any other fund, but it would be only from the shortlisted stocks. Entire universe would not be available for a stock selection, because first round of filtration is on the risk. So those stocks
Mhm.
only with a low volatility would be available for stock selection. Unlike in other funds, it would be wide open.
Okay.
Sector diversification, I've already explained. It is pretty diversified.
Yeah. Fairly diversified. Yes. So next question is, how would this fund perform during a market downturn compared to the standard equity fund?
Yeah, so you have this slide, that slide compares it with the benchmark. I think we
Yeah,
cannot like compare with the different funds. Benchmark is the most better way to compare. You can refer to that slide of downturn.
correct. Can you just show it once again for everybody's convenience, if you
Bhavesh,
can? That was actually a very powerful slide.
yeah, Bhavesh, can you?
Yeah. So, Vaibhav, if you could just explain a bit to our partners, and if you can create a small sales pitch based on this slide. Uh, Vaibhav, I hope I'm audible to you.
Yeah, can you hear me?
Yeah. audible now.
Yeah, so this slide shows the kind of sectors where it can invest. And I think, Bhavesh, if you go 2 slides down, Bhavesh, or whoever, yeah, one more slide. Yeah, this is also these both of these slides. You can see, you can refer how the performance of this strategy has been against the benchmark. So it is outperforming 60-65% of the time. And with active management, we want to improve this hit rate, right? And you asked me what is a pitch, right, for the
Yeah.
product.
Yeah.
So pitch is very simple. Pitch is that you are investing in something fundamentally which is gone up less, which is relatively better valued at this point in time, and you are investing something which is against the volatility because market has been volatile, so you have to do something which is against.
Vaibhav, I
So you are
think you're on
investing
mute.
in something.
Yeah.
Yeah, sorry. I'm So you are investing in something which is which is less volatile. The second part is that, see, this product is a combination of, largely it's a combination of different defensive sectors, right? Along with that, there is some exposure to cyclical sectors also, right? So I think this is a unique product in that sense because in one product itself you are combining 3-4 defensive sectors. So instead of focusing on only one particular type of stocks, right? You can actually have exposure to all the defensive stocks.
Agree. Uh, Vaibhav, I think again you're on mute.
Hello?
Yeah,
Sorry. Yeah.
much better.
No, just a second. Give me 30 seconds. I'm just okay. Sorry. Yeah.
Yeah.
So that is the second part, right? It's a unique product where we will have combination of all the defensive sectors, where you have a combination of all the defensive sectors, uh, right? And I think where you have combination of all the defensive sectors, and I think third part is that basically it should, the intention is to deliver the performance in a down market. I think these 3 points are most relevant.
Correct. Thank you for highlighting this point. And I think
give me
my
30
last
seconds.
question to you is...
Give me 30 seconds. Give me 30 seconds. Just
Sure.
yes. Yeah. Go ahead.
Yeah. So I think my last question to you is, in what kind of market scenario would this fund be most effective?
It's consolidate in a market which is consolidating or which is downward trending, which we have
Correct.
discussed in
Yes.
some of these slides.
Yes. Certainly. So I think this was it from my side. And I think I would like to extend a heartfelt thanks to all our esteemed partners, and especially to the esteemed presenter, the fund manager from the ICICI Prudential AMC, for taking the time out and briefing us all about our latest NFO ICICI Prudential Minimum Variance Fund. Your expert insight and detailed explanation about this fund have helped us for the deeper understanding of the product. And definitely it will be beneficial to all our partners, and it will definitely give us the potential benefits. We truly appreciate your valuable guidance and looking forward to the engaging sessions once again with you. And thank you so much for your time and effort. Thank you, and thank you to your team as well. And thank you all our partners for taking out time.
Okay, thanks a lot. Thank you.
Thank you so much. Thanks, Vaibhav, once again.
Thanks.
Thank you all our partners. And with this, we are logging out. Thank you.